Hey guys, welcome. In this video, we are going to derive a greater understanding of options trading and how the process of hedging your trades can come to fruition and protect um, a position that you may have opened. So, in general terms, hedge is considered, a connotation to include, greed or what I might say as high risk. But what it also implies is that a hedging position protects another position. So the way I'm defining it is a hedge is a series of trades that protect a primary or initial position. We're going to discuss hedging with a specific example in the oil market. I'm going to discuss MRO, how when MRO is headed in a down direction, I predicted that it would go down by, I'll say, $4 or $5 from where it was trading about a month ago, with an expiration out in September or October. Should that position make it as far as I predicted, it'll net 100% or more in revenue. To protect that position, I'm using technical analysis where I will let some time elapse, and then because the stock is headed in the down direction, the cost of a protecting or hedging bet in the opposite direction will be uh, minimal. However, its gains will be greater than that which was going in the down position. I hope you are getting a good grasp of hedging through this discussion. Now let's dive into the example. All right, so in this example, we're looking at the price of MRO from about a week or so ago, or 8 trading days, and today. Initially, I discussed that about 3 weeks ago. The stock, which was trading a little higher than it is now, um, was headed in the down direction. And if you follow oil, you know that oil can change in price based on a lot of external factors, but the big one is OPEC's meetings where they decide to regulate supply. When you regulate supply and demand, you're basically attempting to affect price. So by cutting supply, which is what they had done in April, um, the demand automatically goes up, so the price um, extrinsically, intrinsically, automatically went up. I benefited from that OPEC decision almost coincidentally because I like to keep my eye on stocks, and I noticed that the MRO stock had been in the, I guess, yearly low territory, and over a weekend I realized a gain in the options priced by several hundred percentages, which was a really nice win. So now I'm paying attention to it more because the price, although it went up in April, it has gone back down to where it was. So I want to keep an eye on it. More importantly, I'm practicing hedging, and I'm practicing being a consistent trader. So protecting bets not just by stopping out of trades, but by trading the opposite direction when the timing is right and the pricing is right. The key to understand is if the stock is in a certain direction, the price of the option in the opposite direction is naturally going to be cheaper because the interest or demand in it is low. People pile into stocks as they're going up. They're greedy. They're not advanced traders, and they don't understand hedging. So a position in the up direction might be offset when the stock suddenly stops going in that direction and turns into a bear market. Conversely, a stock that's going down, like MRO, may turn into up position. So I'm protecting my up position with my initial down position. So I'm hedging my bets, as it were. All right. In this case, the stock was trading around $23 a week ago. Is now trading, in the direction of the 21, 22 range. As you can see, the red candles show precipitous declines. What you're looking at is a volume bar chart below the candlesticks, and then you're looking at what are called momentum indicators. The percent R is a momentum indicator. It went into oversold conditions on Wednesday. That's when I first made my video to show an introduction to hedging. I said that the momentum indicator suggests that this may turn around. So Thursday, the stock turned around. I opened a position, and I'm going to check on it daily until the position expires. And I'm going to be updating my video daily as well, so you can see the power of options. In the time since I made my first video on Wednesday till Friday afternoon, the $22 option went from $1.11 to $1.80. That's over 50% gain. Again, if you'd invested 111 on Wednesday and sold out today at 180, you would have made $70 or more than 50%. That's the purpose of this video, to teach you about hedging and to teach you about making money in a market that changes. So we called the bottom. We were lucky. We'll see how much more this position can grow. And if you'll notice, the other momentum indicator at the bottom is called the relative strength indicator. It suggests that the stock is neither overbought or oversold. And I believe that that is more of a longer term picture. So I think this stock could go up or down. But we're in two positions. We're in the hedge short position at $18 and the long position, which again is now at $1.80. All right, I hope you enjoyed. Let's go on to the next video. So let's take a look at the stock option for MRO with expiration June 23rd and June 30th. The purpose is we're going to look at this on a daily basis and show how the price of the option can grow because of the volatility in the market or the change in directions. As I had said before, at $1.11 is what you could have bought this stock at, or the option. The option worth $1.11 for that strike price there at 22 bucks. That same price, 22 bucks, a week later is trading a little bit higher. Today, again, I said the value of that that option is at about $1.80. So again, this is a day-by-day tracker of what profits you could be making on this particular stock. I'm drawing a line in the general vicinity of where the stock is trading at and where the options are in the money. So anything in the yellow is in the money. Anything in the money in yellow is highlighted above these lines. So this chart, this PowerPoint slide titled Prices Options MRO Weekly 2023 June. This particular slide was made on Wednesday evening. Today is Friday evening. What I'm showing in this slide is the price of the options as it was on Wednesday. And I'm also introducing the concept of spreads. Spreads that are of a specific nature. They're called calendar spreads. A calendar spread is the right to buy a stock at a specific price in the future, as well as the right to sell it at a particular price in the future. They sometimes go by calendar credit spreads or debit spreads. I am looking at what amounts to a net debit spread. In other words, I'm paying for it as opposed to taking, selling generally means you're taking money in. So let's look at an example. Let's look at June 23rd strike price of $22.50. It says there the price was $84. I'm using that that number, for the June 23rd strike price, and then $96 as the price of that same option in June 30th timeframe. So again, the way options are calculated, are mathematical computation, but if I can afford to wait until June 30th, and I'm willing to pay $96, then if this stock indeed makes it $1 above that projected strike price, or makes it to $23.50, I've made my money back. I paid $96 for it, but I'm making well over $96 if the stock makes it there. In other words, the intrinsic value is the difference between the actual and the projected price. So if the stock goes up to $24 and I had bought that call $23.50, I'm making 50 bucks on it. We'll go into details about it later, but we're also looking at a different price target now. The next strike price above it, we said 23 bucks. If you look at the second column, the price is 62 for the 23rd date, and $1.73 for the 30th date. Again, those are the prices people are willing to pay to have the right to buy the option to buy that stock at that price before expiration. Okay, again, this is what they were worth on Wednesday. Let's look at what they're worth today, and we'll show you how much they've increased by. All right, guys, let's have a look-see and talk about this particular slide. On the left, we see the price of that option as it was yesterday. On the right, we'll look at the price of that option as it was today. Let's start at the price of $22 that we had indicated we were interested in initially. So you can see the $22 call price traded between 115 and 128 at the end of the day. The last trade was $1.11, which amounts to $111. So 100, because an option is the right to buy a stock in the future, but you cannot just buy one. You have to buy them in lots of 100. Every share that you buy at $1.11 translates into $111 for the 100 shares or one option. So $22 strike price for MRO was going to cost you $111 on Wednesday. Today, the $22 strike price is now costing you $1.81. Okay, $1.81. The change there is indicated by $59. So you would have made $59 on that $111 purchase in the blink of an eye. So where were you during all this? Were you looking at the charts? Were you looking at the relative strength index? Were you making a rational decision? If not, this is what this sort of exercise and PowerPoint presentation is designed to help you. If you like what you see, hit the like and subscribe button. We're going to do this on a weekly basis through the course of the year, picking stocks that we find through various outlets. We're going to start a community and learn how to make money. Just to be clear, if you had bought, let's just say, I usually trade in amounts between 200 and 300 at a time. When I do trade, I don't trade every day. So if I had bought this, so I've only actually bought one position because I'm really just doing this as a live trading example. In the future, we could bet more. But what I'm saying is, if we had invested $222 when I did on Wednesday, beginning of the day on Wednesday, the $222 has gone up, by 100 already. So for doing nothing, we've made, about $100. Now, why are they called hedge funds? Because they tend to do the same thing with more money. So if they had invested $1,110, they would be up at close to 2,000 by now. And we know that they trade in the millions and they affect the stock market. So we're learning to be like them with smaller increments. Example number 2, let's look at the $22.50 strike price. On the end of the day on Wednesday, it was trading at 98. Today it's trading at 145. Again, an increase of about 50%. Okay, that's quick money. Okay, we still have 20 days to expiration. So let's see what happens. Later we'll cover the Greeks. What does that mean? The rate of increase of a stock option over time. I hope you liked what you saw. Again, to recapture the previous slide discussion, we do talk about spreads because sometimes people will hedge their hedged bets. So if I look at the 22.50 strike price and I look at June 30th, it's going for $1.28. Let's say I agree to sell that same, let's say I agree to borrow that option on June 23rd. That is to say, I'm receiving 98 cents or $98 for the right to sell somebody my stock at 22.50. Well, if the stock goes above 22.50, that person is going to buy it. And so I'm out those 100 shares, but I actually, I paid money, I received $98 for it. So usually what you do is you sell out of that position. You automatically get exercise because you've already bought the 128, the same deal for the future. Let's go over that in more detail next time. But again, calendar spreads are two purchases that effectively offset each other. So if I'm buying June 30th, 22.50, call it 128, but I'm selling June 23rd, 22.50 strike price at 98 cents. I'm really paying something like $30 for that long-term position, and I'm hoping that it doesn't get above 22.50 until June 24th. Let's go into more detail on that next time.